Let's get back to natural gas. We've seen natural gas blasting to 13-year highs over the past few sessions. Has pulled back a bit, some investors taking profits. But is there more upside and, of course, risk here for huge users of natural gas? We are joined by Eli Rubin, Senior Energy Analyst at EBW Analytics Group. Thanks very much for coming on the show, Eli.
Thanks, Andrew.
Let's pull up a 5-year chart maybe for Henry Hub natural gas. What a spike. What caused that? Was it a short squeeze?
Yeah, absolutely. So earlier this month, definitely technicals played a role, but we really see fundamentals primarily underlying this recent move higher. And so right now, the market is fairly concerned with the storage trajectory through the upcoming winter. Every year, the market tries to build up inventories during the April to October injection season so that we can draw them down during the heating season ahead. And typically, the market likes to enter winter with something on the order of 3.6 to 3.9 trillion cubic feet of natural gas heading into the upcoming winter. Right now, however, projections are kind of pointing towards closer to only 3.4 trillion cubic feet in October. And so really the market's trying to go ahead and lift that storage trajectory. And so economics 101, higher prices, the goal is to bring on more supply or reduce demand and free up additional supply to flow into storage. Right now, however, the market keeps pushing prices higher, but we're on the price inelastic portion of both the supply and the demand curve. And so prices are moving higher, but fundamentals aren't really loosening. And so as a result, we just see prices pushing higher, and that upside risk remains likely to continue on a seasonal basis.
We have seen U.S. oil production nearing 2-year highs or pre-pandemic levels, but has the same been happening in natural gas?
Not quite to the same extent. So currently production is sitting just below those highs. Recent highs were reached in December, and the market has been struggling to get back to that same level. So even in the best of times, it normally takes 6 to 9 months for the planning and investment necessary to bring new natural gas production online. So it takes, CEOs have to decide to allocate CapEx. You need to go find the rigs, find the frac crews, actually hydraulically fracture and complete the wells, and eventually, build out gathering systems and bring the supplies online. Right now, we're far from that best case scenario. We're seeing labor shortages in the oil field. We're seeing equipment shortages. We're seeing just a general supply chain disruptions. And so that time frame is being extended out further. So we do eventually expect to see a supply boom. We think in the United States that supply could grow as much as 3.6 BCF a day in the second half of the year. We think that Canadian production could grow as much as 1.2 BCF a day this year. But that boom is likely to be more concentrated in late Q3 and Q4. And in the meantime, the market remains concerned with that storage trajectory that we were talking about earlier.
So I'm just looking at figures here from Bloomberg. Lower 48 dry gas production, something like 95.5 billion cubic feet per day. And that is apparently up 4% year over year. So is that much lower than the increase in demand we've seen in the past 12 months?
Right. So we've seen a lot of new LNG export facilities come online. We've seen a lot of power sector demand come online as well. And so demand has been rising, but I think one of the key points is some of that production growth has been a little bit slower, especially coming out of the winter, than many analysts expected. We had a particularly cold winter that resulted in short-term supply disruptions, and that went ahead and has really kind of set back that production trajectory. Looking forward, though, again, as we see supply take longer to react to prices, that leaves the market to balance on the demand side of the equation. And so prices continue to move higher in search of that demand destruction, but it's not really happening quite yet. And so we think that, in the short term, like I said, this remarkable skyrocketing of prices that we saw earlier this month is likely to lead to the short-term pullback, that longer-term fundamental underpinning remains likely to lift prices into the summer.
So Bloomberg estimates that something like 12.5 billion cubic feet a day are going to the LNG export terminals. And just to reiterate, American production is about 95 billion. So it sounds like more than 12% of America's gas production is already going to the exports.
Absolutely. And that number, the LNG export is actually off a little bit currently. It was closer to 13.5 BCF a day as recently as 6 to 8 weeks ago. So we are seeing a lot flowing to exports, but the bigger issue is really relative to expectations. We've seen on the power sector demand in particular, those numbers just come in particularly strong. And so typically when you get a bullish scenario, natural gas prices rise, and then you could switch off of natural gas and instead burn coal or sometimes even oil to generate electricity. But currently, natural gas prices have risen to the point where that switching isn't really occurring anymore, where that resource is largely exhausted and tapped out. And so that really opens the door to substantial further upside price risks ahead. Even from current levels, we expect this to be a very volatile, a very bumpy ride. Like I said, both supply and demand are price inelastic in the short term, and it remains possible that we could get some bearish shocks that result in as much as a 25 or 30% decline over the next few months. On the other hand, though, it's possible that prices could even double from here.
Sorry, what did you say? It's possible that prices could double from here?
It's possible that prices could double. It would likely not occur until late fall or the run up to winter. But in a bullish scenario, we need to find that natural gas and free it up for uses like home heating. And so the market remains completely underbalanced, and it remains possible if you get a bullish shock, if you get a hot summer, if like last year you have a hurricane knock off Gulf of Mexico production, the market could be even shorter than it is currently. Wow. And so that additional bullish catalyst is likely to shoot prices higher until you get that demand destruction. And we don't know precisely because prices haven't been this high, as you mentioned earlier, for 13 years. It's not well-trod territory, but it seems likely that demand destruction would not kick in until prices get to, at least the low teens, in terms of dollars per MMBTU. So again, I want to be clear that there remains a significant possibility we get some bearish shocks. Even right now, weather forecasts are suggesting a cool summer is possible. That could allow this building bullish pressure to relent. But this upside remains far larger than many people anticipate.
And just finally, I think we have a chart showing Canadian natural gas inventories. They're pretty tight compared to last year. Where does Canada fit into the mix here?
Yeah, absolutely. Great question. So Canadian inventories are actually currently at their lowest level since 2014. And so those low inventories are in part, we saw the coldest January and February since 2014 earlier. You'll note the correlation with weather. And also because demand has been so strong in the lower 48, Canadian supplies have been increasingly exported to the US. And so we expect that Canadian production will rise and help offset some of that tightness. But in the meantime, those upside risks continue to be particularly troubling.
Amazing stuff. Yeah, of course, natural gas, always famed for its volatility. Eli, it was great talking to you. Thank you very much indeed.
Thank you, Andrew.
Eli Rubin of EBW Analytics Group.